Welcome to the deep dive. Today we're really getting into something fascinating, trying to predict the price of gold. It's always been this alluring challenge.
It really has. And for investors, getting that prediction right, having the highest accuracy with the lowest possible error, that's huge.
Absolutely, it's the goal. So our deep dive today is all about exploring some, well, cutting-edge research. They've built this powerful hybrid model.
That's right, a hybrid model specifically designed to nail that gold price prediction with exceptional accuracy.
Okay, let's unpack this a bit. People have been trying to guess where prices are heading forever, right? But when global finance really took off, the need for actually good predictions became, well, urgent.
Oh, definitely. We've come a long, long way from just gut feelings. The early days were all about econometric models. You had pioneers like Tinbergen, Cochrane, Orcutt.
Right, the early statisticians?
Exactly. They were trying to use math to map out economic relationships, but, they hit snags pretty quickly. Real-world data is messy.
How so? What kind of problems?
Well, a big one was autocorrelation in the errors. Basically, if your model was off one day, that error would kind of bleed into the next prediction, making it less reliable.
Ah, okay, like a snowball effect.
Sort of, yeah. And that's where Durbin and Watson came in. They developed a test, a statistical test, to actually detect that specific problem. It was a big step, realizing you had to check if the model's assumptions were actually holding up.
So they were building the foundations, but finding the real world didn't always fit the neat theories.
Yeah.
What came next after tackling those initial issues?
The next really big leap was in 1970. Box and Jenkins, they introduced Box-Jenkins analysis.
Box-Jenkins, okay. What was special about that?
It was just a very structured and relatively simple way to analyze time series data over time, and make forecasts. It gave researchers a solid framework. Then, fast forward to the early 80s, and you get RCH and GAR-H models.
RCH and GAR-CH, they sound complex. What were they for?
Good question. So markets don't just move. Their wildness, their volatility changes too, right? It's not constant.
Uh-huh. Sometimes things are problems, sometimes they're crazy.
Precisely. That's called conditional heteroscedasticity. Fancy term. But RACH and later GRCH, these models could actually predict those changes in volatility. Not just the price direction, but how much things were likely to swing.
Wow, okay. That sounds incredibly useful for risk management.
Hugely useful, and researchers jumped on it for commodities. People like Callis, Frusi, Kroner used GAR-CH for cocoa, corn, cotton, gold, silver, all sorts of things. There was even a variation, TGRCH, that seemed particularly good for gold fluctuations.
Okay, this is where I feel like it gets really interesting. Because even with GAR-CH, financial markets are just so complex, nonlinear.
Yeah.
Did these traditional models eventually just sort of hit a wall?
That's exactly what happened. They struggled with the sheer complexity, the patterns that weren't straightforward lines. And that's when researchers turned towards, well, artificial intelligence.
Ah, AI. Makes sense.
Yeah, they started experimenting with things like genetic algorithms, fuzzy logic, and especially artificial neural networks, ANNs. These tools are much more flexible.
So people started mixing them, creating hybrids.
Exactly. We saw a boom in hybrid models. Like Hamid and Ekwal used a GARCH-AN mix for the S&P 500 back in 2004. Parisi and Diaz focused on gold using improved ANNs in 2008.
Okay.
But a really standout example is Christian Poler and Minotolu in 2014, their hybrid neural network GARCH model. It showed a 25% improvement for predicting the instant gold price and an amazing 38% boost for future gold prices.
Wow, 38%. That's a serious improvement.
It really was a clear sign that combining these different techniques, especially the AI element, could unlock a lot more predictive power.
So how does this new study, the one we're focusing on, build on all that? What's their particular approach, their secret sauce?
Well, their goal was really explicit. Achieve the absolute lowest error, the most reliable prediction possible, and they did it by creating this very specific ARIMA Stepwise Regression neural network model.
Okay, quite a mouthful.
It is, but it shows the layers. It's a true hybrid, It carefully combines the classic time series analysis with ARIMA, insights from technical indicators used by traders, then uses smart variable selection with regression, and then feeds that into an artificial neural network.
Fascinating, a multi-stage process. And what data did they feed this beast?
They kept it focused. 3 main things. Gold prices, obviously that's the target. Then 2 big external factors known to influence gold. U.S. oil prices, specifically WTI.
Right. Oil and gold often move together, or inversely.
Exactly. And the euro versus the U.S. dollar currency pair, another key relationship. They gathered daily data for all three from the start of 2015 to the start of 2019.
Okay, 4 years of data.
Yeah, and they split it. The first 3 years, Jan 2015 to Jan 2018, that was the training data, teaching the model. The last year, Jan 2018, Jan 2019, was held back as the measurement data, to test how well it actually performed on new stuff it hadn't seen.
Makes sense. And for gold they used?
The daily final price, the first price, the highest, and the lowest. All in US dollars from com.investing.
Okay, let's break down this hybrid model then. First piece, ARIMA. We touched on it, but why is it the foundation here?
Right, so ARIMA. Time series models like ARIMA are fundamental because financial data is a time series. You're looking at observations over time. ARIMA stands for Auto-Regressive Integrated Moving Average.
Right.
Think of it having 3 parts. P, D, and QP is the autoregressive part. How much does the current value depend on past values? Q is the moving average part. How much does it depend on past prediction errors? And D is the integrated part, which is crucial.
Why is DUDE so crucial? You mentioned something about non-stationary data.
Exactly. A lot of financial data isn't stationary. Its basic properties, like the average price, drift over time. Gold prices tend to trend upwards or downwards, right? They don't just hover around a fixed average.
Okay.
Most standard time series models need the data to be stationary to work properly. The D in ARIMA handles this using differencing. It basically looks at the change from one day to the next instead of the absolute price. That often makes the data stationary.
Ah, I see. It stabilizes the data for the model.
Precisely. It's a transformation step.
So how did ARIMA actually do when they applied it just to the gold data?
Well, first they looked at the chart. And maybe, just maybe, it looked stationary, but then they did the proper statistical check, the ACF autocorrelation function, and it clearly showed it wasn't stationary. The correlations died off way too slowly. So, solution. Apply that differencing. They used D1, just a single difference between consecutive days.
And that worked.
It did, made the gold data stationary. Then they had to figure out the P and Q values. They used other plots, PACF mainly, and some statistical criteria like AIC and Schwartz to find the best fit.
Which it turned out to be?
It turned out to be ARIMA, 2 intras, 2, 1, 2 autoregressive terms, 1 difference, and 2 moving average terms. And that model, just on its own, achieved 94.2% accuracy.
94.2%. Okay. And they measured that using MAP, you said?
Yes, MAPE, mean absolute percentage error.
Can you quickly remind us what that means?
Sure. It's just a really common way to measure forecast accuracy. It tells you, on average, what percentage your forecasts were off by. So a low MPE is good. 94.2% accuracy means the MAPE was around, what, 5.8%? Pretty decent.
Got it. And did they do the same ARIMA process for the oil and eurodollar data too?
Absolutely. Foundational models for those as well. For WTI oil, it also needed 1 difference, D1. The best fit was ARIMA 10. That one got 96.8% accuracy.
Even better.
Yeah. And for the eurodollar pair, again, needed differencing. The model was simpler. ARIMA 0101, and that achieved 97% accuracy.
Wow. So ARIMA alone was already doing pretty well on these.
It really was. It shows that even in seemingly random market movements, there are underlying time-based patterns that these relatively traditional models can capture quite effectively. It gives you a strong starting point.
Okay, so that covers the pure time series part. But markets aren't just math, right? There's that human element, the psychology, trader decisions. How do they factor that in? Technical analysis, I guess.
You got it. That's the next layer. Technical analysis tries to read the market's mood, basically. It uses calculations based on past prices and volume to spot trends and predict where things might go next, based on, collective trader behavior.
So what specific technical indicators did they look at in this study?
They focused on 5 key ones. First, the exponential moving average, EMA. It's like a smooth price line, but it weights recent prices more heavily, so it reacts faster.
Okay.
Second, RSI, the relative strength index. This measures how big recent gains are compared to recent losses. Helps see if something is potentially overbought or oversold, usually over 14 days.
Right, I've heard of RSI.
Third, the stochastic oscillator. This compares the closing price to the range of prices over a period. It uses 2 lines, Pertis Pay and Pertedi, where Pertis D is a smooth version of Pertei. Helps spot momentum shifts.
Okay, Pertieg and Pertidi.
And finally, the Williams indicator, or Persera. It's quite similar to the stochastic, also looking for extreme buy or sell levels, but the calculation makes it fluctuate a bit more smoothly sometimes.
So they calculated all these indicators?
For the training data, yes, adding more potential predictive signals to the mix.
Right, so now they have the ARIMA predictions and these technical signals.
Yeah.
But you mentioned earlier that just throwing everything in doesn't always work. The paper talked about this, right? The too much information problem.
Exactly. This is a really critical step in their process. They actually tested it. They built an initial regression model using the ARIMA forecasts, all 5 technical indicators, plus the gold open, high, and low prices to predict the closing price.
And how did that do?
Surprisingly poorly. Only 87% accuracy using MEP.
87. That's way worse than the ARIMA models alone.
Yeah.
Why would more data make it less accurate?
It seems counterintuitive, doesn't it? But it happens a lot. Too many variables can just add noise. Some might be redundant, basically telling the model the same thing in different ways. That's multicollinearity. It confuses the model, makes it fit the training data quirks too closely, and then it fails to generalize to new, unseen data.
Overfitting.
Overfitting, exactly. So the key wasn't just adding data, it was selecting the right data. And that's where stepwise regression came in.
Okay, stepwise regression. How does that help select the best variables?
It's a systematic way to build a model by either adding or removing variables one at a time based on statistical significance. They tried 2 approaches. First was forward stepwise regression. You start with nothing, just an empty model. Then you add the single variable that gives the biggest improvement in accuracy or minimizes error the most. Then you add the next best one, and so on, until adding more variables doesn't really help much.
And what did the forward method pick?
It selected 6 things: the gold open price, the predicted oil price for the next day from the oil ARIMA model, and 4 technical indicators: RSI, stochastic per K, Williams per SAR, and a 10-day EMA. That boosted accuracy up to 96.07%.
Much better. And the second method?
Backward stepwise regression. This works the other way around. You start with all the potential variables in the model, then you remove the worst one, the one whose removal improves the model the most or hurts it the least. You keep removing variables one by one until you can't improve the model anymore by taking things out.
Interesting. So what did the backward method settle on?
It picked a slightly tighter set: the gold open price, the predicted oil price, and just 3 technical indicators: RSI, Williams per SAR, and the 10-day EMA. It dropped the stochastic per C.
And the accuracy.
Even better, 97.47%.
Wow. So backward elimination worked best here.
It did. Higher accuracy. So those 5 variables, open price, predicted oil, RSI, Williams per SAR, EMA 10, were the ones they decided carried the most predictive signal, without the noise. That carefully curated set was what they passed on to the final stage.
That selection process itself made a huge difference then, from 87% up to almost 97.5%.
Massive difference. It really highlights that in prediction, especially with complex data, less can definitely be more. Smart selection is crucial. It improved accuracy and made the model potentially faster and more efficient.
Okay, that's a key insight. So now, the final stage, the brain, maybe,
Yeah.
the artificial neural network. How does this take those 5 selected variables and push the accuracy even higher?
Right, the ANN. Think of it like a simplified network inspired by the brain. You have an input layer where you feed in those 5 selected variables, then 1 or more hidden layers of artificial neurons that do complex calculations and pattern recognition, and finally an output layer that gives you the prediction, in this case, the predicted gold price.
And how do these neurons work?
Well, each connection between neurons has a weight. The network learns by adjusting these weights based on the errors it makes during training. There are also activation functions that determine how a neuron responds. The goal is to minimize the overall error measured by a cost function.
So how do they set up the neural network for this specific gold problem?
They use the 5 variables from the backward stepwise regression as the inputs. Then, crucially, they decided to use just 1 hidden layer.
Only one. Why?
It was a deliberate choice. More layers aren't always better. 1 layer can often be enough. It helps prevent that overfitting problem we talked about, and importantly, it keeps the calculations faster. For traders who need quick predictions, speed matters.
Makes sense. Did they specify how many neurons in that hidden layer?
They did. They actually tested it, experimenting with 1 neuron up to 10 neurons in that layer. They found that using exactly 6 neurons gave the best results.
Okay, 6 neurons and activation functions error measures.
They used a common activation function called ReLU. And for measuring error during training, they used mean squared error, MSE, for tuning the hidden layer weights, and MAPE, again, for the final output layer weights, keeping it consistent.
And the grand finale, what was the final accuracy of this whole hybrid ARIMA stepwise SN system?
This is the impressive part. The final accuracy, using this carefully constructed pipeline, reached 99.29%.
Wow, 99.29. That is incredibly high.
It really is. Compared to the initial 87% or even the 97.5% after stepwise regression, it's another significant leap. It really shows the power of combining these methods in the right sequence.
Okay, so let's tie it all together. The genius of this ARIMA technical regression stage is
Yeah.
artificial neural network model. What's the core takeaway?
It's really about the synergy and the smart sequencing. You start with ARIMA for the basic time patterns, you add technical indicators for market sentiment, then the absolutely critical step, using stepwise regression to filter out the noise and select only the most powerful predictors.
That selection step seems key.
It's arguably the most important differentiator here compared to just throwing everything at an ANN. It boosted accuracy significantly, remember, from 87% to 97.5% before the ANN even got involved. It primes the input for the neural network.
It makes it more efficient, too.
Right. Then, feeding that optimized, cleaner set of variables into a carefully tuned neural network allows the ANN to do what it does best, find those complex nonlinear relationships, and achieve that peak 99.29% accuracy.
So this isn't just about using fancy tools. It's about using them intelligently, in the right order, with that crucial filtering step.
Precisely. And the implications are pretty significant. For anyone involved in financial markets, that level of accuracy means potentially much lower risk, better portfolio decisions, just more confidence in navigating those markets. It's not just theory, it's got real-world value.
Absolutely. Okay, as we wrap up this deep dive, this has been fascinating. But here's something to maybe think about.
Well, this study nailed gold prediction, but think bigger. What if this hybrid methodology time series, smart variable selection like stepwise regression, or maybe even others like random forests, as the paper suggests, feeding into AI, what if it was applied elsewhere?
Like where?
Well, think about predicting complex climate patterns or tracking consumer trends, maybe predicting equipment failures in factories using genetic algorithms as hinted. Any really complex system where you have lots of data but need to find the real signals. Could this blend of techniques unlock new insights in totally different fields? That's the really exciting question, I think. What else could we understand or predict with this kind of approach?